Now let's bring in our market panel. Joining us now, Eric Johnston from Cantor Fitzgerald and Unlimited's Bob Elliott. Guys, happy Friday. Bob, you think this expansion can go on for a while, even if it's paused today, because we don't have a persistent situation where yields are up, stocks are down, slower spending. Why does that mean this can go on? Why is disaster not like right around the corner?
Well, I think from a real economy perspective, we're seeing a situation where income growth remains relatively healthy. You're seeing good wage growth. That's translating to good nominal spending growth. And that's keeping the economy going and powering on. The trouble is it's a little too much in terms of inflation, which is a bit of a concern for the Fed. And it's also probably not quite strong enough to meet those sort of extreme earnings expectations that are being priced into the equity market as we move to the back half of the year.
But you think this is a good situation, still relatively speaking, for stocks?
Well, I think in general, as long as we continue to have decent nominal growth continue, you're going to have certainly a range of sectors where we'll continue to see, continued earnings growth, continued momentum. The real question is, where are those extremes in terms of pricing in very, very high earnings expectations, and how are those going to really be achieved? How are you going to get stocks with 20, 30, 40% earnings growth expectations in the context of a 5 to 6% nominal GDP growth? That's a little more questionable, and I think we're starting to see maybe some questioning about how extreme those expectations are relative to what the reality might be.
Okay, speaking of questioning, Eric, you seem to be calling a top in this AI hype, and you think stocks are going to move sideways from here at best?
Yeah, so I think we're at a short-term sort of tactical top in this frenzy that we've seen over the past month, where the upside is really accelerated. If you look at the largest cap names that have reported earnings in May and June, you've seen a situation where estimates have risen by anywhere from 0 to 7%, yet you've seen stock prices in these mega names rally anywhere between 15 and 50% over the course of the last month. And we think it's gotten a little bit ahead of itself in the short term. So we look at some short-term indicators. If you look at the RSI and the QQQ, it's gone above 80. We've back-tested it. It happens very infrequently over the last 25 years. But when it has happened, about half the time you've seen a meaningful downside, meaningful sell-off over the next month. If you look at the narrowness, even within the NDX, the equal weight versus the cap-weighted NDX, that's also gone to extremes. We're not a big believer in breadth being an indicator overall, but the extreme nature of what we've seen over the last month is causing us some concerns. So this is much more of a tactical call. As you know, this has been the part of the market we've liked relative to cyclical, small cap, and everything else.
Yeah.
But we just think in the short term, it's a little bit extreme.
Because some people are going to remember that you were bearish for a while at the end of last year, I guess through last year. That wasn't quite the right call. You adjusted and said, actually, I like the mega caps, relatively speaking, but now you're adjusting again and seeing even those mega caps have gone to extreme?
Yes, exactly. I mean, when we think about the market on a market neutral perspective, for the past year, we've liked those big secular AI levered names and have said to be underweight sort of everything else, in particular cyclicals and more mid cap names. And, the reason why we have concerns around the cyclicals and mid caps is because, and small caps is because they've got, more leverage. They don't have the secular tailwinds and are much more subject to the actual economic growth and the headwinds that Fed policy is putting on this market. But now we just think from a tactical perspective, as we look out the next month, we think there's risk of a decent reversion in a lot of the very loved names. I mean, if you look at the money that is piled in over the past month into growth funds, you look at some of the declines in short interest, it kind of creates risk right now that I think we all need to be wary about.